Ever dreamed of, like, cracking the stock market code? Like predicting that next big winner and retiring early, maybe to a private island.
Who hasn't, right?
Exactly. Well, that's what we're going to dig into today, whether you can really beat the market or if it's, a fool's game.
Right.
We're taking a deep dive into this paper by Eugene Fama, Efficient Capital Markets 2.
It's a classic.
Yeah, it's a bit dense, which is why you're here to guide us through it.
And it's one of those papers that, even though it was published back in '91, people are still arguing about it today.
Really?
Yeah, because it kind of throws a wrench into some of our basic assumptions about how the market actually works.
Okay, well, let's break it down then. So Fama starts with this concept of efficient markets, meaning stock prices already factor in all the information out there. But there are different levels to this idea, right?
Exactly. The strongest version, which even Fama admits is like totally unrealistic, assumes that everybody gets all information instantly. And not only that, it's free for them to act on that information.
Right, so it's like if some amazing news about a company came out, every single person would buy that stock at the exact same time.
And that's not how it works.
Yeah, talk about a market crash.
Right, total chaos.
So then there's the weaker and probably more realistic version of efficient markets, right?
Right. It considers that information takes time to spread. And it acknowledges that, trading, it has its costs. This version basically says that prices reflect information, but only up to the point where it's not profitable for anyone to try to exploit those discrepancies.
Makes sense. But this is where I always get tripped up. Fama talks about this thing called the joint hypothesis problem. Can you explain it? Maybe like I'm 5.
Okay, so imagine like a pie eating contest, but you're blindfolded, right?
Yeah, okay.
You can't just say, this pie is good, so it wins. You need like criteria.
Right, like the crust or the filling.
Exactly. So the Jane hypothesis problem is like that blindfold. Fama is saying you can't test for market efficiency all on its own. You need a model for pricing, a way to tell what a correct or efficient price should even be. Otherwise, you've got no way to know if the market's right or wrong.
Okay, I think I get that. So, like, with that pie judging analogy in mind, let's jump into Fama's research.
Yeah.
He looks at a bunch of different things, starting with, like, return predictability. Like, can you really predict those future stock prices or what?
Exactly. One thing he looked at was if past returns could actually predict the future ones. And this is where it gets interesting, because there is some evidence that they can, but only over like longer periods, like 2, maybe even 10 years.
Wait, hold on. So are you saying that, like, the stocks I picked, like, way back when, they could actually mean something now?
Well, slow down. Remember the pie contest and that blindfold?
Right.
Just because there's this possible link between past and future returns, it doesn't automatically mean the market's inefficient.
Good.
It could just be that expected returns, they change over time for perfectly rational reasons, and maybe those reasons just take a while to become clear.
Okay, but then how do we separate those long-term trends from actual market inefficiency?
Well, that is the question, isn't it? And Fama actually points out that it's really tough to tell those two apart. It's like trying to figure out if a baker deliberately changed their pie recipe or if they just, I don't know, accidentally used a different kind of sugar.
I mean, that sounds like a happy accident, but I get what you mean. So it's not just these past returns that researchers have looked into, right? What about, like, dividends?
Yeah, you're right. Fama, he also explored using things like dividend yields, which is basically looking at how much of the pie, so to speak, that each shareholder gets. He found that this, along with other measures like earnings price ratios, those seem to have some predictive power as well.
Are you serious? So there are these clues in how a company is doing that can actually, like, give you a peek into how its stock's going to do in the future.
It's not a crystal ball or anything, but it does make you wonder. And get this, one of the most surprising things that Fama found was that this predictive power, it was strongest with smaller companies, which you wouldn't expect, right? You'd think it'd be easier to predict those bigger, more well-known companies.
Okay, yeah, my mind is blown. So we've got past returns, dividend yields, and earnings price ratios. It's like maybe, just maybe, you really can see into the future of the market, even a little.
It's tempting to think so, but before you go, betting everything, Fama also looked into something called a contrarian investment strategy, which is basically like choosing the pie that nobody else wants.
Because it might secretly be the best one. Okay, tell me more. So contrarian investing, it's like going against the grain, right? Trying to find those hidden gems. Did Fama's research actually show if that works?
The results are kind of a mixed bag. Like sometimes it works, sometimes it doesn't. There's definitely some evidence that it can work, but it's not like a a guaranteed recipe for success.
It's not foolproof.
Exactly. And there's still a debate about whether it's a real thing or just, a statistical fluke.
Ah, so the mystery continues.
Yep.
Well, while we ponder that, let's move on to the next thing, event studies.
This is where it gets real. We see the market actually reacting to things. Like, when a company announces they're merging with another one or if they change their dividend, we see how the stock price reacts.
Right, so it's like a test of how fast information spreads and how quickly those prices adjust, right?
Exactly. And what's really interesting is that sometimes the market reacts super fast, like instantaneously. The news comes out, the price adjusts, boom, done. But then other times,
Other times there's this lag, what Fama called post-announcement drift.
post-announcement drift. Okay, now you have to explain that.
Okay, so imagine, like, you hear a rumor at a party, right? At first, everyone's talking about it, but then, like, days later, people are still discovering new little details, new angles to the story.
Right, it takes on a life of its own.
Exactly. So it's like, instead of everyone reacting to the news all at once, it kind of slowly spreads out over time as more people catch on.
Okay, but isn't that a sign that the market, isn't actually that efficient?
That's the big question.
Mhm.
And like a lot of things with this, there's no easy answer. Remember that joint hypothesis problem.
The pie judging. Right. Some people see this drift and they say, see? The market's inefficient, it's slow. But others, they say it might be totally rational. Like maybe there are things going on that our models just aren't picking up on yet.
Okay, so more mystery. So we've got these event studies showing us how the market reacts, or doesn't, but it doesn't really solve the big question about efficiency.
It was just one piece of the puzzle.
Yeah.
And to get the full picture, we got to look at another angle. Tests for private information.
Okay, now this is getting juicy. This is where we see if some people really do have an edge in the market. Like, do they know something we don't?
Yeah, that's the idea. We're talking about whether some people have access to better information and if they can use it to their advantage.
So, insider trading, secret strategies, like in the movies.
Well, maybe not that dramatic. But Fama did look at insider trading, where people inside a company use information that the public doesn't have.
And I'm guessing those folks tend to do pretty well for themselves.
Yeah, insider trading can definitely be profitable. But what's more interesting is how the market reacts to it, or rather, how it doesn't always react. Like, older research suggested that maybe the market was slow to catch on to insider trading, which would, create opportunities for some.
Right.
But newer research, it suggests that it might be other factors, like the size of the company, not necessarily market inefficiency.
Interesting. So it's not as straightforward as it seems. So insider trading aside, what about other kinds of private information? Like what about those Wall Street analysts or those big investment fund managers? Do they actually have some secret sauce that helps them beat the market?
That is a great question, and one that Fama looked into pretty deeply. He looked at the track record of those analysts, the ones who get paid to analyze companies and make recommendations.
Yeah, yeah. Do they actually know what they're talking about?
Well, there's some evidence that some of them might be onto something. Fama specifically looked at this thing called the Value Line Investment Survey, which basically ranks stocks based on how well they're expected to perform. Like imagine a ranking system for pies, but for stocks.
So Value Line, they're like the expert pie judges of Wall Street. Did they live up to the hype?
It's pretty surprising, but yeah, their rankings actually seem to have some predictive power. Stocks that they ranked highly, they tended to do better than those ranked lower.
Okay, so maybe those analysts are onto something. But what about the really big players, like those professional fund managers? Do they have access to some secret stash of information?
Ah, that's the million-dollar question, right? Unfortunately, the answer's still a little murky.
So even with all their resources, those fund managers can't consistently pick winners.
Well, some studies, especially the early ones, they found that mutual fund managers, they didn't really do much better than the market overall, especially once you factored in their fees. But more recent research has shown it's not that clear-cut.
So there's still hope for them.
Maybe. But remember our pie judging dilemma. It's tough to judge fund performance because the models we use to figure out what normal returns should be, they can really skew things. Different studies use different models, and that leads to different conclusions.
So the blindfold strikes again. So where does this leave us? Do some people have better information, or is it all just like luck and timing?
Well, that's the question we'll be grappling with as we head into the final part of our deep dive. We've covered a lot, but we've still got a lot to unpack as we look at what FAMA's findings really mean.
So we've gone through this whole journey,
Yeah.
right, trying to figure out if there's some secret to beating the market. But where do we even land after all this? What's the big takeaway from Fama's research?
Well, that's the million-dollar question, isn't it? And like we've seen, it's not exactly a simple answer. Fama doesn't really give us a clear yes or no about whether markets are truly efficient, but he gives us this really useful way of thinking about it.
Okay, so no magic formula for picking stocks, but it seems like this whole idea of market efficiency is more than just a theory. Like it actually matters for how we invest.
Right, totally. If we really believe in efficient markets, it means that trying to consistently beat the market, it's probably not going to work because all that information, it's already baked into the stock prices. So unless you've got some like seriously unique insight, it's unlikely you'll beat it all the time.
So does that mean we should just like give up and put all our money in index funds?
Not necessarily. Remember, Fama, he knows that markets aren't perfect, like information doesn't always spread instantly and trading costs money. Plus, there's always a chance that someone might have a little bit of an edge, even if it's just for a short time.
Okay, so there's still a glimmer of hope for us aspiring stock-picking gurus.
Maybe. But the real lesson here, I think, is that investing well isn't about chasing every little opportunity or trying to outsmart everyone else. It's about understanding the risks, spreading your bets, and thinking long term.
It's like that saying, slow and steady wins the race, right?
Exactly. And that actually brings us right back to Fama's work. Even if markets aren't perfectly efficient, they're pretty darn close.
So after this deep dive, what's the one thing you want listeners to really chew on?
Here's a thought. If markets are mostly efficient, but there might be these little pockets of predictability, how does that change how you invest? Does it make you trust the market more, or do you double down on trying to find those hidden gems?
That's a great question to leave us with. Thanks for guiding us through this. Really makes you think.
My pleasure. Until next time.